Hi there everyone, this is Royston. It's been a while since I last put up a video for NOF readers and I intend to do that on a more regular basis ahead. I'm starting off with a quick video today to just share the best ETF in my view to replicate the performance of the S&P 500. Now, some of you who are more investment savvy will probably have heard of the SPY ticker and use that as the de facto ETF to partake in the S&P 500 growth. Let me show you why that might not be the most ideal solution. Before I disclose my preferred ETF, for those who don't really know what an ETF is all about, let me give you a quick 1-minute tutorial on ETF. So, imagine that you have got $1,000 to invest. Instead of buying, say, 7 shares of Apple, you can now purchase 500 different blue chip companies. It's like buying a basket of fruits, but instead of bananas and oranges, you're now buying a basket of blue chip stocks like Apple, Microsoft, Google, and Facebook, etc. Of course, your ownership of the individual stocks will now be in a very small fractions. So that sounds like a fantastic way to diversify your portfolio or to one single purchase. Another benefit of ETF is that it trades just like a stock. You can buy and sell them in the market during market hours, which is as convenient as it can get. All in all, ETFs remain a particularly useful asset class for a new investor to start his or her investing journey without the hassle of selecting individual stocks, which will expose them to company-specific risks. Say, for example, the unfortunate passing of an instrumental CEO might result in a sharp fall in the company's share price. By investing in a range of companies instead, company-specific risks can be drastically reduced through diversification. So now, we have got a quick and dirty background of what an ETF is. Let's get into the meaty portion, which is to identify the best ETF in my view to replicate the performance of the S&P 500. As I've previously mentioned, the SPY ETF, which seeks to replicate the performance of the S&P 500 index, is the most popular ETF in the world. In fact, it is the most widely held ETF in the world by investors with its asset under management, or AUM, amounting close to 300 billion. The next most popular ETF is the IVV, which also looks to replicate the S&P 500. The only difference is the sponsor of the fund. The AUM for IVV comes in at a distant second of about 230 billion. These two are the most widely held ETF in the world and both look to replicate the S&P 500. However, these two ETFs are not my preferred choice. Instead, my preferred ETF to replicate the S&P 500 is a less well-known ETF which goes by the ticker SCHX. This is the Schwab US Large Cap ETF. Now, the SCHX is an ETF that holds approximately 770 large cap stocks in its portfolio, which is significantly more than the 507 stocks currently held under SPY. However, unlike SPY, which has close to 300 billion in AUM, SCHX only has approximately 27 billion in AUM. SCHX is one of the ETFs that I have featured previously in my article on stocks that have consistently outperformed the S&P 500 over the past decade. In that list, there are many growth-related ETFs which explains their outperformance versus S&P 500 over a 10 years horizon. ETFs like the uber-popular QQQ, which tracks the 100 largest tech stocks in the US, have outperformed the S&P 500 by a tremendous 263% on an absolute basis over the past decade. Has the tide changed in today's context where growth is no longer the favored investing strategy and it's now time for their value counterpart to shine? No one can say for certain unless they've got a powerful crystal ball in front of them. However, I'm not here to debate if it should be sticking to a growth strategy or jumping ship favoring a value angle. As can be seen from the table, the Schwab US Large Cap ETF and the Vanguard Large Cap Index Fund ETF, or VV for short, have consistently outperformed the S&P 500 over the last decade. These are ETFs that are focused on investing in large cap stocks, pretty similar to that of the S&P 500. Instead of buying the popular SPY, an investor can select the less well-known SCHX or VV ETFs if their goal is to replicate the performance of the S&P 500. Now, take for example, you start off with $10,000 10 years ago back in January 2011. And every year thereafter, you add $10,000 to your investing portfolio, looking to replicate the performance of the S&P 500. If you have bought into the SPY ETF, you have ended up with a grand total of 269,802. If you have instead bought into the SCHX or VV ETF, you have ended up with 273,780 or 274,305 respectively. Clearly, investing into VV generated the greatest returns, approximately $4,000, $500 more than the SPY. Now, the difference of $4,500 is not a huge amount, but it's like free money. And who doesn't like free money? A word of caution, as usual, historical performance might not be representative of future performance, but if one goal is to replicate the performance of the S&P 500, then selecting either the SCHX or VV ETF is the better option, albeit a less well-known one to investors. Alright, that is all the financial tidbits that I have for you today. Do stay tuned for more interesting financial information in this channel, and I would appreciate very much if you hit the like button if you enjoyed the short video that I brought to you today. Once again, this is Royston, signing out.